If Bitcoin keeps falling, will strategy finally be forced to sell? Over the past few months, this question has appeared everywhere. Every major Bitcoin correction brings the same headlines. Will Saylor sell? Will strategy be liquidated? What happens if Bitcoin falls to $55,000? To many investors, the answer seems obvious. Strategy owns more Bitcoin than any other public company. Its balance sheet is dominated by a single asset. Its stock rises when Bitcoin rises, and it falls when Bitcoin falls. Saylor has repeatedly said he has no intention of selling. Because of that, many investors see strategy as one giant leveraged Bitcoin position. The logic sounds simple. Bitcoin falls. The company's assets shrink. Debt becomes harder to manage. Eventually, strategy has to sell Bitcoin. It feels inevitable. But what if that entire story is wrong? What if Bitcoin falling isn't what forces strategy to sell? After looking at the company's financing, its debt structure, and the billions of dollars it has raised over the past few years, a very different picture begins to appear. Bitcoin could fall much further than most people expect, and strategy might still keep every single Bitcoin. Because the real question isn't, how low can Bitcoin go? The real question is, how long can strategy survive if Wall Street stops funding it? Those are two completely different questions. And understanding that difference changes everything. Because the biggest risk facing strategy may have surprisingly little to do with Bitcoin itself. Most people imagine a very simple business model. Saylor wants more Bitcoin. He borrows money. He buys Bitcoin. Bitcoin falls. The lender demands repayment. Strategy sells Bitcoin. Simple. Except, that's not how strategy actually works. Over the past several years, the company has built a much more sophisticated financing machine. The first source of funding is common stock. Strategy issues new shares. Investors buy them. The company receives fresh capital. Some of that money is used to buy more Bitcoin. The second source is convertible notes. These are bonds, but unlike traditional margin loans, they usually don't require daily collateral adjustments. If Bitcoin falls, there isn't an automatic margin call. There isn't a forced liquidation. The third source is preferred stock. Another way to raise long-term capital, and another way to spread financial obligations over many years. Now notice something important. What's missing from this entire structure? There is no giant margin account waiting to explode. There is no bank automatically selling Bitcoin the moment prices fall. That doesn't mean strategy has no risk. It simply means the risk is different. Much different. The real pressure doesn't come from Bitcoin's daily price. It comes from something else. Time. Every bond has a maturity date. Every financing strategy eventually depends on refinancing. And every public company depends on one thing above all else: investor confidence. As long as Wall Street believes in the strategy, the machine keeps running. New capital arrives. More Bitcoin is purchased. The cycle continues. But if that confidence disappears, everything changes. And that's where the real story begins. Now, let's test the idea. Imagine Bitcoin falls to $55,000. The headlines explode. Investors panic. Social media says, this is the end. So, does strategy have to sell? Not necessarily. Because falling prices and forced selling are not the same thing. A company's assets can lose value without creating an immediate cash problem. Think about your own house. If home prices fall by 30%, you don't automatically sell your house. You keep living in it. The same principle can apply here. Bitcoin can fall. Strategy's balance sheet becomes smaller. But unless the company suddenly needs cash, nothing forces an immediate sale. This is where many investors become confused. They assume lower prices automatically create liquidation. That is true for a trader using margin. It is not necessarily true for a public company with long-term financing. So if Bitcoin falls from 100,000 to 80,000 or even to 55,000, the first question should never be, will they sell? The first question should be, when does the next debt mature? Because prices don't create bankruptcy. Time does. And that's the piece almost everyone ignores. Now, let's change the question. Forget Bitcoin for a moment. Imagine something else happens. Wall Street stops providing new capital. No new stock buyers. No new convertible notes. No new preferred shares. Now, the clock starts ticking. Every company has financial obligations, interest payments, preferred dividends, operating expenses, and eventually, debt maturities. Strategy has already prepared for this. The company created a US dollar reserve, specifically to support interest payments and preferred dividends. It wasn't an accident. Management understood that cash buys time. Today, the company still has billions of dollars of Bitcoin, and it also maintains a dedicated cash reserve. That reserve was never meant to buy more Bitcoin. It exists to protect the balance sheet when markets become difficult. This is why Bitcoin falling doesn't automatically create a liquidity crisis. Time is the company's most valuable asset. Every month, that strategy can avoid selling Bitcoin is another month waiting for financing conditions to improve. So perhaps the most important number isn't Bitcoin's price. It's the number of months the company can continue operating without raising a single new dollar. And that's exactly what we'll calculate next. Let's run a stress test. Assume Bitcoin falls to $55,000 and it stays there for 6 months. At the same time, assume strategy can no longer raise new capital. No new stock. No new convertible notes. No new preferred shares. Now ask yourself, What happens next? Question number 1. Does Bitcoin falling automatically trigger liquidation? No. There is no giant margin loan waiting to be called. Question number 2. Does the company suddenly owe all of its debt tomorrow? Again, no. Its obligations are spread across time. Question number 3. Can the company continue paying interest, operating expenses, and preferred dividends? That depends on one thing: cash, not Bitcoin. Cash. If existing cash reserves are sufficient, the company keeps moving forward. Maybe not comfortably, maybe not forever, but survives. Notice something important. In this entire scenario, Bitcoin never needed to recover. It only needed to stop getting worse. Because survival creates something incredibly valuable: time. More time to refinance. More time for capital markets to reopen. More time for investor confidence to return. But what if Bitcoin doesn't recover? What if capital markets remain closed for an entire year? That's where the real pressure begins. Let's go back to the original question. If Bitcoin keeps falling, will strategy be forced to sell? After everything we've just examined, the answer is more complicated than most headlines suggest. Bitcoin alone doesn't force the company to sell. Falling prices don't automatically create a liquidity crisis. What really matters is how long the company can survive. Every month, without selling Bitcoin, creates another opportunity. Another opportunity for financing conditions to improve. Another opportunity for investors to regain confidence. But time isn't unlimited. If Bitcoin remains weak for long enough, if capital markets remain closed for long enough, if debt eventually reaches maturity before financing returns, then the balance sheet starts making decisions that management can no longer avoid. That's why the biggest risk was never a single Bitcoin price. It was always the combination of price, time, and access to capital. Bitcoin determines the value of the assets. Time determines how long the company can wait. Capital markets determine whether waiting is even possible. And perhaps that's the lesson most investors miss. MicroStrategy doesn't succeed simply because Bitcoin goes up. And it doesn't fail simply because Bitcoin goes down. Its future depends on something far less obvious: whether Wall Street continues funding the strategy. And that raises an even bigger question: who is actually funding MicroStrategy? Because once you understand that, you'll understand why this story may be much bigger than Bitcoin itself.